Hey everyone, welcome to another edition of Macro Views at Grinnell Capital. We're going to give people a minute to join in. In the meantime, you can take a look at the new back surrounding I got down here. This is the work of my wife and co-founder. She's also an interior designer extraordinaire. So if you need any help in that realm, don't be afraid. Dana at grinnellcapital.com is her way to get in touch with her. Okay, let's get rolling. So 2022 market outlook is what we're going to talk about today. Thank you for tuning in. Those of you that are live right now, thank you for listening to the recording. Those of you that may do so in the future. Opportunities and risks, like that title's not that, that's pretty fair. That's fairly obvious given what's going on in the market even today. And let's get right to it. Let's try to get right to it. There we go. So the agenda for today's talk, and again, I try to keep it brief. What do I, 30 minutes? Is that what I'm targeting? 20, even quicker. Headwinds going into 2022, tailwinds into 22. So the good things that are happening and the not so great things that might be occurring. I want to talk a little bit about the dichotomy in the market that we've seen this year. That's still going on to an extent, but it's really incredible. Positioning going into 2022. So what I mean by that is what we're using at Grinnell Capital for kind of our baseline positioning going into 22. And then what I think is going to be 3 waves of opportunity coming in 22 to take advantage of. And then finally, garbage time. And you'll have to just wait to see what that's all about when I get to it. Headwinds. Got any Denver advisors out there? You guys know that scene, don't you? I-70 headed east on a Sunday. No thanks. But headwinds we have for the 2022 market. I mean, inflation, I'm not going to spend a lot of time here. We all know what's happening. We just got wholesale prices this past week, a record high. CPI has been going nuts. So prices are up, not news. I think the big thing to think about is really how long do these elevated prices continue. I wouldn't be surprised if we were peaking right now. Omicron might have something to do with that too. But that wouldn't be a big surprise. But I do think, I think it's one of those things. And as Chairman Powell recently discussed, I think that prices stay higher a little bit longer than has been expected in the past. Federal Reserve is a big one. So Fed meeting yesterday. FOMC targeting 3 rate hikes in 22, 3 more in 23. Accelerating the taper. We kind of all thought this would happen, right? This is not necessarily news, a little more hawkish stance out there. But what I liked, Chairman Powell, during his press conference, I don't know if you saw it, very measured, very calm, very matter of fact, answering the questions, really seemed to be in charge of what he was doing, not flustered. So I think that it is what it is in terms of the Fed has to get off the 0 rate. It's been overdue, but that's kind of the big deal. The real big deal is we're coming off this exceptionally accommodative posture for the Fed. Potentially, we're coming off of it for the first time since 2009. You guys remember the taper tantrum from 2018? That didn't work out so well. So this is really coming off of it for the first time. And you're already seeing the ramifications of that in the market. If you look at those crazy expensive stocks, a lot of which we have owned, those elite growth companies, those innovative companies that are trading at 30, 40, 50 times forward sales, it's all fun and games when they're going straight up. But those things have been going down and going down hard for the past month. I don't think that's over. A lot of those stocks are still really expensive. We'll talk a little bit more about that. But that's one of the first signs of seeing this removal of this over-accommodative stance with the Fed. Omicron, another headwind. This is nothing new to anybody now. We're all familiar with COVID. It looks like the news out so far is that it's not as lethal, but is much more contagious than the Delta variant or the other variants before that. The risk here is it does spread to the extent where it does cause another slowdown in the economy. That's the risk. I think that is what's impacting the bond market right now. You look at the way the interest rates are behaving. They're not ticking up, as with the dot plots would indicate that the Fed pointed out for next year. I think a lot of that has to do with Omicron and the thought that it's going to slow things down a little bit. And slowing growth. So, on a GDP basis, I don't think it's an academic stretch to say that we're probably reached peak growth on a year-over-year basis, and we will be slowing going forward as comps get tougher. I don't think that's hard to imagine. I think growth still does remain healthy in general. All right, moving on. Tailwinds. Look at that nice powder day. Strong U.S. consumer. So balance sheet strong, and not just the consumer, but corporate America. Corporate America has their share of debt, but their debt is inexpensive. Cash flows are high, and the U.S. consumer has probably never been in better shape, honestly, in terms of what their balance sheet looks like. Definite positive. We are a consumer-based economy. Other tailwind, the deflationary effects of innovative technology. So you guys know Cathie Wood, ARK. Satya Nadella, Microsoft CEO, they've both have spoken to this. More have spoken to this. Much people that are much more smarter than I am talk about how these elite software enterprise software companies and other innovative technology companies, their main purpose is to drive efficiency and lower costs for their customers. And they're very effective at doing this. So I think that is going to be combative to this hyperinflation that we have, that overall deflationary effect. I think that's a good thing. Moving forward. Okay, so dichotomy in the market. This is amazing. So you guys probably saw this, or at least heard about it. I think it came out earlier this week or late last week. Dave Kostin, I think he does good work over at Goldman Sachs, their chief U.S. equity strategist, pointed out that 51% of the returns in the S&P 500 since this past April are a result of 5 companies accounted for 51% of the returns. That's 5 out of 500. And if you look over here on our handy dandy chart, you see the 5 up at the top part of that graph. So Apple, Microsoft, Google, NVIDIA, Tesla. That's them. If you were underweight those or underexposed to those, you underperformed this year, period. End of story. So it's just pretty wild. And if you look here at the remaining, this chart just shows you a longer term perspective going back to the start of the year. And it says 35% of the S&P 500's returns were from these 5 stocks. And the other 493 all clustered down together right there. So pretty amazing. I think it's a bit of a risk when it comes to the passive investing approach. Personally, in other words, if you go and put money into the SPYs, you're pretty much buying more of those 5 stocks is largely what you're doing, given the amount and the weighting they have, right? So the risk is something happens to those, that's not ideal. But anyway, that's not today's topic. Moving on. Positioning going into 2022. So barbell approach, those of you that have worked with me before know that I love to talk about a barbell approach because that is my strategy that we use here at Grinnell Capital. Value on one side, growth on the other, to keep it real simple, right? So you've got sort of things going in both directions. You're almost having an internal hedge in a way, if you will. So I think this barbell approach makes a ton of sense heading into 22. I wouldn't abandon growth, but I think you need to have the value component as well. So we talk about quality growth, software under pressure today. If you look at the IGV, big ETF for enterprise software, CLOU, another one, more the cloud computing type names, all under pressure. I think that it makes sense to take a look at those with the strong balance sheets, pricing power, cash flow, Salesforce, and Adobe. Adobe's down big today. Let that come down more. Microsoft, right? Those big fortress balance sheet type stocks can work into 22. What else? Select industrials. The reason to select, again, if you've worked with me before, I like to be really sector specific in what's going on out there. I don't like broad industrials and a potentially slowing economic growth. Doesn't make sense. But I think you can have select industrial exposure to the right verticals, meaning aerospace, I think still has some strong tailwinds going into 22 and 23. I think that's just getting going again because all the false starts with these COVID variants and what have you. And I also think that infrastructure. So the infrastructure bill gets passed, doesn't get passed, whatever. We still need more energy. We need more renewable energy type infrastructure. All these things are going to be built more so going forward. Battery plants, what have you. So those types of names, we're looking at like a Emerson, Boeing obviously fits the bill when it comes to aerospace, aftermarket suppliers into the aerospace. Think about a Raytheon, a Teradyne. I think all those can make sense going into 22. Engineering and construction, along that same theme of infrastructure, needing to upgrade the grid, needing to install more renewable energy at either utility level or what have you. Engineering and construction companies. Jacobs Engineering is a big one. KBR, one you may not have heard a lot about. It's an old rollout of Halliburton. Insider buying recently at KBR. I think that's interesting. Quanta Services, PWR, and Mastech, MTZ is another one. Oh, I'm too loud. Too fast. Oh, I'm too fast. Slowing it down. Semiconductors. Semiconductors under pressure today. There was a bearish note, or not a bearish note, kind of a word of caution note, I think, out of Morgan Stanley yesterday, that talked about all the pull through of demand and double ordering, or what have you. It could come to fruition next year. If it does, I think it's more of a second half 22 phenomenon. I think semis can work at least through the first half of 2022. And they're not the old cycle that they used to be. They don't just all go down like exponentially when the cycle is over, because I think that the cycle thing is kind of gone. You look at like an NVIDIA, if you exited that name, you've always been sorry you did, right? These big quality semiconductor names like a Marvell and NVIDIA, an AMD, Qualcomm now, NXPI. I mean, those are the kind of names I think you can scale into over time on weekdays. All right, value side. Healthcare, there's a reason it's in bold. I like healthcare a lot going into 22. Non-cyclical, right? So if the economy slows, doesn't matter. Healthcare is non-cyclical. It's also, and this isn't my data point, I need to do more work on this, but what I have heard anecdotally, CNBC talking head, was that it trades at a 30% discount to the S&P 500. Very interesting if that's true. I do want to show a good ETF for healthcare, the broad healthcare sector, is the XLV. I'm going to go and I'm going to try to pull that up for you real quick. I'm going to escape out of this. Whoop. And I'm going to pull this up. Stick with me. I don't think that worked. Hold on, going back to the slideshow. All right, never mind. And oops. There we go. Sorry. So anyway, you can pull up the chart. I just couldn't do it. So the XLV is breaking out to new all-time highs just yesterday and today. Interesting because a lot of other components of the markets are trading at all-time highs and have been doing so. Healthcare has lagged. Biotech has been a disaster. MedTech has lagged. You name it, it's lagged so far in 21. Going into 22, I think it looks really good. Whether you talk about a Pfizer that's still cheap after the big run that it's had, an Eli Lilly, we just, in fair disclosure, bought some this morning. Great data out on Alzheimer's, actually plaque removal, which is really exciting going into 22. Good numbers out of them. Like a Vertex Pharma, speaking of biotech, recent insider buying there, I believe at the 195 level. So check that out. Healthcare, XLV, I like it a lot going into 22. Financials, again, talking about cheap, we're talking about the broad banks, lending component. In my mind, I think that as Omicron kind of calms down a bit, you will start to see those interest rates tick up. Very positive for the banks when it comes to their lending. So an easy way to play this, XLF gives you broad exposure to the financials. KRE gives you regional bank exposure, almost like a kind of a higher beta way to play it. If you want to get name specific, a Wells Fargo is super cheap on their turnaround. Bank of America, still cheap. I like what they're doing. Those are a couple I would look into. Mining, I should have the word select here in front of mining, just like industrials. So select mining, not all mining, because again, going into potential slowing growth, I don't want a ton of exposure to things like mining, which are early cyclical type of sectors. But I think where you've got verticals into sustainable trends like electric batteries for EV cars, so that's copper. So you're talking about a Freeport McMoran or a Tech Resources. I think those make a lot of sense. Special situations like a Cleveland Cliffs with iron ore. It's a restructuring story, taking down debt, very cheap stock on a PE basis. Lots of insider buying. Check it out real recently. Lots of insider buying at current levels. And traditional OEMs, so Ford and GM. Guy by the name of Adam Jonas over at Morgan Stanley, excellent auto analyst. GM is his top pick right now. We own Ford, have owned Ford for a bit. Love it. Love the CEO. Farley over at Ford. I think he's doing a bang up job. I think they're going to continue to make noise in that space. So yeah, moving on. So 2022 will probably be bumpy. I'm smiling because I think it's going to be bumpy, especially the Q1 first half because of all these cross currents and lack of conviction out there. You look at today, it's just like software stocks all of a sudden are just not software, semiconductors are just getting crushed, and you got banks up big. There's just no strong conviction out there right now. So there's going to be opportunities to take advantage of. Omicron will be the first one, I think. So that's a Q1 event. I think we do reach the peak when it comes to Omicron breakout and what have you in Q1. So you're talking about, again, travel and leisure type stocks, whether they're hotels, casinos. When it comes to casinos, you want to take a look at maybe an MGM or a Caesars. They are far along when it comes to the sports gambling legalization in the States. I think they're probably going to, I don't know if they're going to win it, but they've got an experience that like the DraftKings and the FanDuels can't really offer. They can offer points in exchange for, rewards at casino sites. So you do so much, trading on the sports book, you get to come and watch a show in Vegas for free, things like that. DraftKings can't do that. So if the electronic and the experience is the same, why wouldn't you go with like an MGM or a Caesars in exchange for points and what have you? Anyway. I think Boeing, again, Omicron, all this stuff's being held down, but I think Boeing makes sense going into 22 in Q1. Next one, quality growth under pressure. So you're going to still see, I think, some of those quality names that we like are going to continue to come under pressure. One of the reasons is as these more expensive names get sold, some of these funds are going to get redemptions. People are going to want their money back. And how are these PMs going to get liquid? They're going to sell things that they can. That's Apple. That's Microsoft. That's all those stocks that have done really well. So watch out for those on weakness. You could be a buyer there, I think. Financial technology, fintech, I think makes sense. So PayPal and Square. PayPal, CEO recently bought stock. I think that one makes sense. Square is trading under 5 times sales. That looks interesting. It acts like total which is wild, but I think under 5 times sales, you can dip a toe. Cybersecurity. So whether that's Palo Alto Networks, that's probably the cheapest name in the space right now. Then you go out to the other ones out there, whether it's CrowdStrike, Zscaler, what have you. Those will probably continue to come under pressure because they are expensive. They are some of those names we talked about. And again, cloud software. So that's whether even the sales forces or what have you are potentially going to come under continued pressure because of the other selling going on. That'll be an opportunity in Q1, I think. And the trickiest ones, the innovation and game changer type stocks, the ones we all tend to love are going to probably continue to get hit. This is probably going to be an entire first half event. I don't know when, who knows when these things actually bottom. But you guys know the exposures, whether it's the metaverse, electric vehicles, you look at Rivian, Tesla, autonomous driving, artificial intelligence, Snowflake, amazing company, awesome, probably one of the best enterprise software companies that's going to be launched this decade. And it's probably going to still come under pressure because it's crazy expensive. Genetic sequencing and editing space, love that a lot. You look at like a Beam Therapeutics or NTLA is another one. Those can have huge wins going forward. Could be one of the secrets to advanced therapeutics, but they're very expensive and they've got a lot of revenue that's in the coming years. And cryptocurrencies, I want to just talk about that real quick. I'm not going to give a big stance on crypto. What I will say is I think we've all seen the same people that own speculative stocks also own cryptocurrencies. So they're not going to be this big cushion and a natural hedge in times of economic stress. They're going to come under pressure as they have and may continue to do so. I do like crypto. I'm a long-term believer, but that's a different topic. So get your shopping list ready is the point here in these types of names and let them come to you because they will. Garbage time. So yeah. So what I mean by this, and you guys have all seen the football games where the game's pretty much over. You've got a winner that's been determined already by, potentially the second quarter, scores out of reach and really nothing really matters in the last quarter of the game, what have you. So it's kind of like that right now in the market when it comes to what happens with stocks. People that have losses. So let's take used to be called Square. Now it's called Block. What's it called? I think it's called Block. They changed their name, right? So that literally goes down every day. It's tax loss selling. People that have gains and everything else are selling Square, get the tax loss. They don't care the price. They know they've got a loss. They'll just keep selling it down, selling it down, selling it down. That's a potential opportunity, right? So if that's a name that's on your radar, I'm not telling you to go out and buy it right now, but if it's something on your radar, I would use this to start to nibble on the name when it's down 4 or 5% again. Boeing is another one that fits that bill. Disney could be another one that fits that bill. Down huge so far this year and a potential to just accumulate a little bit. I do think you can probably like PayPal could be PayPal acts a lot better than it did, acts a lot better than Square right now. So that might make sense to maybe accumulate a little bit here. And again, like the Disneys, again, Boeing, names of that nature. I wouldn't touch the crazy expensive stuff. If you want to pick up a little Microsoft or things like that on a big dip, go for it. And I think, okay, so that's it for the outlook. Here's our want more section. So these are other things that we do on a regular basis. I wanted to make you aware of if you aren't already. Smoothies and stocks. It was just a kind of a quick market insight that we provide on Wednesdays on YouTube. My wife makes amazing smoothies usually. Monthly report, first week of the month. We come up and we just rehash the prior month, talk about what happened in the market, what we see going forward. Macro reviews, which is right here. We try to do those every month. Yes, every month. Next one's coming up January 20th. We're going to talk about the metaverse, favorite topic. No one's going to care about it pretty soon because all these stocks are going down, but it matters. Blog posts, we do these twice a month. So check these things out. The more you can kind of look into these things, we appreciate it. And thank you for tuning in. Oh, I'm not going to trade anything I talked about for 72 hours, just, officially. Thanks for tuning in. And you got to look at these disclaimers. Everybody take time to read this. That's right. And this one. Yep. Cool. I think that's it. Did I forget anything? No, I'm good. Thanks for tuning in. Have a fantastic holiday season. Happy late Hanukkah. Happy Merry Christmas. Happy New Year. Kwanzaa. Enjoy. Thanks for tuning in.